Pause for a sec. Drop that coffee mug. Shut those browser tabs. Check the spot price on the monitor. What's visible? Roughly $71. Silent, steady, soothing. That fake figure is working. It keeps you totally chill. But here's the real issue, folks. If you play the charts, you likely tell yourself the shiny is consolidating, holding the line, acting standard. But that ticker isn't real. It is a ghost signal from a rigged paper scheme that ignores what is truly going down on the street level now. While the West glues eyes to screens, the physical market in Asia is shouting a completely different saga. In Tokyo, real silver metal you touch, not contracts that settle in the cash cells for prices equivalent to roughly $130 per ounce. Not due to wild hype, not due to speculation. It is because that is what folks are willing to pay to escape currency risks. $71 on the paper, $130 in the actual world. That gap isn't friction. It ain't tax. It ain't shipping. An 80+% spread isn't inefficiency, it is a fracture. When paper prices and physical costs separate like this, it means the mechanism connecting them has fully broken. The spot price is the price of promises. The street price is the price of certainty, and history remains very clear on this point. When those two diverge, paper always chases reality, never the other way around. This isn't the collapse just yet. This is the warning. And if you get what this gap really means, you will see why it isn't closing, and why what comes next will catch most people completely and totally unprepared. If this already shifted how you view the market, comment one below and make sure you are subscribed. At this point, the skeptics start talking. I can already hear them. They say Japan has taxes. They say minting costs cash. They say shipping metal across the ocean isn't free. And on the surface, that sounds reasonable. Friction exists in every marketplace. But friction does not cost $60 per single ounce. Even if you list every possible expense, fabrication, insurance, transport, and taxes, you might justify $10. Maybe $15 if you are being generous. That still leaves a massive hole in the story. So the real question isn't why the price is higher in Tokyo. The real question is why the gap has not been closed. In a functioning market, this would be the easiest trade in the world. If silver is $71 in New York and $130 in Tokyo, the biggest banks on earth should be printing money. They should be buying metal at the paper price, shipping it east, and locking in risk-free profit by the ton. $30 million here, $40 million there. Banks do not ignore that kind of massive spread. So why aren't they doing it then? Because they cannot do it. The arbitrage mechanism, the plumbing that connects paper contracts to physical delivery, is broken. Large industrial bars sitting in Western vaults cannot be converted into retail product fast enough. Refining capacity is limited, secure transport is constrained. And most importantly, the silver in those vaults is far less liquid than the system pretends to be. If a major bank tried to pull tens of millions of ounces out of the exchange today, it wouldn't trigger a shipment. It would trigger a cash settlement. The system would force them to stay in paper. The bridge between the two worlds has burned down completely. This is what bifurcation looks like. Two prices, two realities. In the paper world, silver is cheap and abundant. In the physical world, it is scarce and expensive. And the longer this persists, the more dangerous it becomes because it tells us something critical. The market is no longer self-correcting now. And when markets lose that function, they don't heal quietly, man. They totally snap. When people see this kind of divergence, they jump to the same conclusion: the banks are finished. I see the headlines already. JP Morgan is trapped. The shorts are dead. This is the end. It is a satisfying narrative. It feels like justice. But it is also dangerous because it is incomplete. Yes, the banks are under pressure. Yes, they are bleeding. But no, they are not about to collapse tomorrow, folks. Let's talk numbers, not emotion here. The big bullion banks hold a massive short position in silver through the futures market. On paper, it looks catastrophic. A move from $71 to $100 creates billions in mark-to-market losses. For a hedge fund, that would be fatal. For a systemically important bank, it is painful, not lethal. These institutions are armored with capital. Hundreds of billions in Tier 1 buffers exist for exactly this reason: to absorb shocks. A multi-billion-dollar loss ruins the bonuses, destroys quarterly earnings, and gets traders fired. It does not automatically shut the doors now. And there is another uncomfortable truth most people ignore. Banks are not gamblers, they are bookies. What looks like a naked short is often hedged elsewhere in opaque over-the-counter deals with the miners and refiners. Losses in one pocket are frequently offset by gains in another. That does not make them innocent, it makes them durable. What they are facing is not a solvency crisis, it is a liquidity squeeze. They need cash to meet margin calls while waiting for the hedges to pay out. That distinction matters because liquidity problems buy time. And time is their greatest weapon. This is why betting on any overnight collapse is a mistake. If you assume the banks die tomorrow, you will over-leverage rush and get shaken out. The institutions can endure far longer than most traders can remain solvent now. The war is not ending, it is changing its shape. This is where expectations become very dangerous. Many people believe that once the system is exposed, price action should explode straight up. A vertical candle, instant justice. But markets do not move on morality, they move on control. And while the banks are losing control of direction, they still control the battlefield now. Direction is physics. Control is strategy, man. The supply dynamics now demand higher prices. The shortage is real. The divergence is real. But the speed of that move is still being managed. The institutions still set margin rules. They still run all the algorithms. They still own the casino. And their goal is simple: make this as painful as possible for anyone using the leverage. The first weapon is volatility. Expect some violent swings. $5 up in the morning, $7 down by the close. Not because fundamentals changed, but because fear creates liquidity. Sudden drops force leverage traders to sell. Stops get hit hard. Positions are liquidated. And every forced sale helps the banks reduce exposure. The second weapon is boredom. After a sharp rally, the price will stall. Weeks of sideways action. No headlines, no real excitement. This phase is designed to exhaust conviction. They want you distracted chasing something else, convinced the move is over. Then without warning, the price jumps again. This stair-step pattern is not random, it is deliberate. Rise, chop, smash, repeat. Each cycle removes weak hands while allowing institutions to reposition quietly. The banks are not trying to kill the rally anymore, they are trying to survive it. That is why this is not a sprint. It is a grind, a slow bleed where patience beats prediction. Those who expect fireworks will panic at the first engineered drop. Those who understand the process will recognize it for what it is, a slow-managed retreat. And while paper prices whip around so violently, something else keeps happening in the background, something the banks cannot control, slow down, or even reverse. The physical supply continues to disappear now. That is the pressure point, and that is where this story turns from financial engineering into something far more dangerous now. Up to this point, everything we have discussed lives inside the financial system. Balance sheets, derivatives, algorithms, but the real threat does not come from spreadsheets. It comes from physics, from metal that either exists where you need it or does not. This is where the narrative changes, folks. While traders argue over charts, a structural supply shock has quietly taken shape. One that cannot be hedged, printed, or regulated away. China, the largest producer and consumer of refined silver on the planet, has shifted its priorities now, not just rhetorically, legally. What is being described as export licensing is not a minor policy tweak. It is a gate. Smaller refiners scrap processors and trading houses. The entities that once fed excess silver into global markets are now effectively locked inside domestic borders. Only state-aligned giants can export, and their mandate is no longer profit. It is security. China burns through far more silver than it mines. Solar manufacturing alone demands massive volumes, and next-generation panels use significantly more metal per watt. That internal deficit means one thing: there is no surplus to export. Every ounce is claimed before it leaves the refinery. This isn't temporary, it is structural. For decades, Western markets used Asian supply to smooth shortages. That release valve is shut. And when a global market loses a major supplier, prices don't adjust gradually, they reset. Now, industrial buyers aren't ordering just in time. They are ordering just in case. Hoarding begins. Safety stacks replace efficiency. And once that behavior starts, it feeds on itself. Banks can manipulate paper. They cannot force a refinery to export. They cannot print bars. and they cannot reverse a geopolitical decision with leverage. This is the variable they can't control, and it's why the pressure keeps building, regardless of what the rig charts say. Because when supply stops flowing, price stops being negotiable. When people talk about silver availability, they usually point to the wrong number. They look at total inventory and tell themselves there is plenty of metal. That illusion is deliberate. The real story is buried deeper in a category most investors never bother to understand. Registered inventory. This is the silver that actually matters, not silver that meets purity standards, not silver that exists somewhere in a vault. Registered silver is the metal that is legally available to settle contracts. It is the last line of defense between the paper scheme and outright failure. And that line is dangerously thin. Right now, the amount of registered silver sitting inside the system represents less than 2 weeks of global consumption, not months, not years, days. Everything else, the so-called eligible silver, belongs to private owners who are under no obligation to sell. The banks cannot touch it. They can't commandeer it. They can only hope someone volunteers. But ask yourself an honest question. If you owned silver and you saw the real world price climbing far above the paper quote, would you hand it over at a discount or would you hold? That is why the eligible pile is frozen. It exists, but it doesn't circulate, which means the entire pricing system is balanced on a shrinking pool of deliverable metal that is being drained every single day. This is not accidental, it is mathematical. When a commodity is priced artificially low, demand doesn't disappear, it accelerates. Buyers rush to the cheapest source on earth, and right now that source is the paper exchange itself. Standing for delivery is no longer an act of speculation. It is an act of rational purchasing. And every ounce that leaves tightens the clock. This is the countdown most people never see. Not a timer on a chart, but a physical limit. When that registered number approaches 0, the system doesn't adjust. It protects itself. And protection in this case means one thing: cash settlement. When most people hear the word default, they imagine chaos, markets crashing, headlines screaming. That is not how modern financial systems fail. They fail quietly behind legal language and procedural adjustments. If registered inventory runs too low, the exchange doesn't panic. It invokes the rules. Physical delivery gets temporarily suspended, logistics are blamed, market stability is cited. Force majeure is declared. On paper, everything is orderly. In reality, it is the moment the promise breaks. Instead of metal, contract holders receive cash, the official spot price, the very currency they were trying to escape. And by the time that happens, the real market has already moved on. This is the trap. A cash settlement isn't a refund. It is a denial of access. While you are handed paper at $71, the physical price gaps to levels that no longer care about charts or fairness. You didn't lose money on paper. You lost purchasing power. That is why this isn't just a pricing event. It is a separation event. Those holding promises stay inside the system. Those holding metal step outside it. And this is where psychology takes over. The moment headlines hint that delivery might be constrained, behavior changes instantly. Industrial users scramble. Funds that never cared about physical metal suddenly demand it, and inventory doesn't drain slowly anymore, it vanishes. We have seen this before in smaller markets, nickel, palladium. When confidence breaks, the exit is not wide enough for everyone, and the silver market is far smaller than most people realize. The irony is brutal. The cheaper the paper price stays, the faster the physical disappears. Suppression accelerates its own failure. This isn't the end yet. But once cash settlement becomes even a possibility, the game changes permanently. Because no one who understands this will voluntarily stay trapped on the wrong side of that line. And that brings us to the most important question of all. What should you actually do? This is where most people make their biggest mistake. They confuse urgency with panic. They see headlines about triple-digit prices overseas and feel compelled to act immediately at any cost. That instinct is understandable, and it is exactly what destroys capital. Paying an extreme premium is not strategy, it is fear. When buyers in Tokyo pay 80% over spot, they are not making an investment decision. They are making an escape decision. Their currency is collapsing and price no longer matters. You are not in that position, and that gives you an advantage. Your edge exists because the manipulation still exists. The banks are holding the paper price down to protect themselves. In doing so, they are subsidizing your entry. Every time the spot price is pushed lower, the physical buyer outside the panic zone gets a discount on reality. Think about the math. $71 plus a modest physical premium puts real metal in your hands for far less than what the global market is already signaling. Same element, same utility, same scarcity, different price for now. This opportunity only exists in one narrow window before the system admits the truth. And here is the rule that cannot be bent. This strategy only works if you hold physical metal, not paper, not ETFs, not unallocated accounts. Those are promises inside a system that is already preparing its exit clauses. Unallocated silver is not silver. It is a liability. You are an unsecured creditor lending capital to an institution that is structurally short the asset you think you own, when stress peaks that claim is settled in cash, not metal. Physical ownership removes counterparty risk completely. No margin calls, no rule changes, no forced settlement. A bar in your possession does not care what the exchange declares. The premium you pay is not a fee. It is insurance against being trapped on the wrong side of the system when the rules change. This market is not rewarding clever trading, it is rewarding correct positioning. And that positioning becomes critical as we approach the final phase. The fatal flaw is thinking the suppression ends in one flashy instant. A single green candle, one news break, overnight revaluation. That is not how the paper derivative scam unwinds when the banking cartel fights hard to survive. What lies ahead is a brutal grind. Spot prices will move higher, but not in a straight line. Sharp rallies will face sudden smashdowns. Exchange margins will rise without warning. Volatility is weaponized to exhaust anyone relying on leverage or short-term conviction. This is not randomness, it is pure filtration. Every spike shakes out the weak. Every crash transfers physical ounces from weak hands to strong ones. Meanwhile, the physical market keeps tightening. Vaults don't refill, supply doesn't magically appear, industrial usage doesn't slow just because spot action becomes uncomfortable. The divergence widens quietly even on days when the paper chart looks very ugly. This is the phase where the stories flip constantly. One week the rally is dead, the next week it is unstoppable. That confusion is intentional. Confused paper traders make mistakes. The disciplined stackers accumulate. Eventually, a line is crossed. Maybe it's vault inventory, maybe it's delivery stress, maybe it's a geopolitical escalation. The trigger won't matter, only the positioning will. When the system finally concedes, the real adjustment won't ask permission. By then, paper spot targets won't matter. The market won't be debating 71 versus 80. It will be debating availability. And physical availability doesn't negotiate. Those holding the metal will not need to sell. Those without it won't be able to buy. That is how repricing actually happens, not through charts, but through total exclusion. The question is not whether this phase ends. It is whether you endure it without being shaken out before the end comes. Because once this great transition completes, there is no reset. There is only the true market price. Chapter 10, the strategy, the lesson, and the final wake-up call. Everything we've discussed leads to one conclusion. This is not a trading event, it is a structural shift. The silver market isn't mispriced, it is breaking under the weight of reality. And when systems break, they don't reward speed or cleverness. They reward only solid preparation. The core lesson is simple, yet uncomfortable. Paper promises are fragile. They depend on rules, trust, and uninterrupted logistics. Physical silver depends on none of that. When stress rises, the system always protects itself first, not the retail participant. This is why the winning strategy is not leverage. It is not timing the perfect bottom. It is not chasing headlines or waiting for confirmation that comes too late. The strategy is positioning before the rules change and then having the discipline to sit through the discomfort. Ignore the noise. Volatility is not a signal to exit. It is a signal of stress. Focus on the ounces, not fiat quotes. Prices will move violently, but scarcity moves in only one direction. When supply contracts and demand becomes inelastic, repricing is not a possibility, it is a requirement. The greatest mistake you can make is believing this window stays open forever. It won't. Once the cartel is forced to acknowledge physical reality, the discount vanishes. There is no second chance at the very same terms. History doesn't repeat gently. It compresses outcomes. Those who stacked early look calm. Those who waited feel totally blindsided. So here is the final takeaway. Do not buy panic. Do not chase fear. Use the distortion while it exists. Hold what cannot be printed, rehypothecated, or settled away. When the dust clears, charts won't matter. Real ownership will. If this analysis gave you clarity, make sure you subscribe, like, and share this with someone who still trusts the fiat price on their screen. And if you've made it this far, comment 1 below. It tells me you're thinking long-term, not reacting short-term. The system is changing. The stacking strategy is set. I will see you on the other side of this.